Are you searching for a way to make your money work harder for you? Welcome to the How to Live Off Dividends compilation for the year. This is more than just a video. It's a blueprint for achieving financial freedom through dividends. From rapid growth strategies to solid long-term plans, we've gathered the most successful approaches from the first half of the year. Whether you're aiming for early retirement or just looking for extra income, this guide will equip you with the knowledge to turn your dividends into a dependable income stream. The first chapters are ideal for anyone looking to begin their investment journey, whether you're starting small or have more to invest. Let's start with how to make $5,000 a month with only $25 per week. Looking to make some extra cash without breaking the bank? With just a small investment of $25 per week, you can start your journey to earning over $5,000 a month. Yes, you heard that right. It's possible. In this video, I'll show you and John simple and practical tips that investors keep secret. I'll show you the drip strategy and how you can make it even better. And in the end, I'll show you how using this strategy, you can turn a $25 per week investment into an over $500,000 portfolio paying over $5,000 in monthly dividends. So grab your $25 and let's get started on the path to financial success. Everything needs a strategy. You need to plan out what you need and how to get there. The same is the case with investing. In our case, our goal is to retire and still have free monthly payments as if you never retired from a job. But the problem is, we only have $25 per week to spare. So the only strategy for this is using the DRIP investment strategy. DRIP, or Dividend Reinvestment Plan, is a smart way to grow your investments over time. Think of it like planting a seed and watching it grow into a mighty tree. Instead of soil and water, you use your dividends to buy more shares, which then generate more dividends, creating a cycle of growth. Here's how it works. Imagine you own shares in a company that pays dividends. Instead of taking those dividends as cash, you reinvest them to buy more shares. This means you own more shares, which in turn generate even more dividends. It's like a snowball rolling down a hill, getting bigger and bigger with each revolution. One of the key benefits of DRIP is compound interest. When you reinvest your dividends, you buy more shares, and when those shares pay dividends, you reinvest them as well. This snowball effect leads to exponential growth over time. Let's break it down with an example. Suppose there's a stock that's worth $20 per share and you own 100 shares of that company. It pays a $1 dividend per share each year. At the end of year one, you'll have $100 in dividends. Instead of cashing out, you reinvest and buy 5 more shares of the stock. Now you have 105 shares of the company. The next year, instead of receiving $100, you'll get $105 in dividends. The following year, you'll own 110 shares, then 120, and so on, each time increasing the dividend amount. Over time, your investment grows larger and larger thanks to the power of compound interest. Another benefit of DRIP is dollar cost averaging. Instead of trying to time the market, you buy shares regularly regardless of whether the market is up or down. This helps to smooth out the highs and lows, averaging out the cost per share over time. Let's see how this works. Suppose you invest $100 every month in a company's DRIP. Some months, the share price might be high, so you'll buy fewer shares. In other months, the share price might be low, so you'll buy more shares. Over time, your average cost per share will be somewhere in between, helping to reduce the impact of market fluctuations. Finally, DRIP offers the convenience of automatic investment. Once you set up a DRIP with your broker, it takes care of everything for you. You don't have to worry about manually reinvesting your dividends or timing your purchases. It's a streamlined process that helps you stay focused on your long-term goals. In the end, I'll show you how this drip strategy can turn a small investment of $25 per week into over a $500,000 portfolio that pays over $5,000 per month. But for that, you need to improve the drip strategy. Now here's how you can supercharge the drip investing strategy by contributing a set amount every week, month, or year. For this video, I'm investing $25 per week in my portfolio. That's $100 per month or $1,200 per year. Let me break down how this investment can make a significant impact on my investment journey. Firstly, by increasing my contribution to $25 per week, I'm accelerating the pace at which I buy more shares. With more money going into my portfolio regularly, I'll be able to purchase additional shares more frequently. This means I'll benefit from compounding at a faster rate as each new share I acquire starts generating dividends sooner. Adding more money every week helps you take better advantage of dollar cost averaging. This means I spread out my purchases over time, so I buy shares when prices are high and when they're low, reducing the impact of big price swings. Putting in $25 each week is simple, and it fits into my budget without trouble. And with DRIP, I don't have to worry about remembering to invest. It's done automatically. By using DRIP and adding money regularly, I'm setting myself up for more growth. My portfolio should keep getting bigger over time as I keep putting money in and reinvesting dividends. Now, when it comes to building a successful DRIP strategy, choosing the right stocks is key. By selecting stocks that meet specific criteria, you can ensure the effectiveness of your DRIP investments and maximize long-term returns. For me, I look into these 4 categories of stocks for my investment: blue-chip dividend stocks, dividend aristocrats, high-yield dividend stocks, and growth-oriented dividend stocks. In the end, I'll show you a selection of stocks using these criteria that utilize the DRIP strategy and have the potential to turn a small investment of $25 per week into over a $500,000 portfolio that pays over $5,000 per month. But first, let's see why these categories of stocks matter. Blue-chip dividend stocks are a popular choice for DRIP investors. These are reputable companies with a long history of consistent dividend payments, indicating financial stability and reliability. Examples include household names like Coca-Cola, Johnson & Johnson, and Procter & Gamble. You need to start with blue-chip dividend stocks for your portfolio. They provide a solid foundation for long-term growth because these companies have proven their ability to generate steady income and reward shareholders with dividends. Secondly, dividend aristocrats are another category of stocks ideal for DRIP investing. These are companies that have increased their dividends for at least 25 consecutive years, showcasing a strong commitment to returning value to shareholders. Stocks like AT&T, ExxonMobil, and Walmart fall into this category. You need aristocrats to stabilize your investment strategy over a long period of time. Since these stocks have been increasing dividends for over 25 years, they're not likely to cut back anytime soon. These companies have a proven track record of navigating various market conditions and delivering consistent returns to shareholders. Additionally, high-yield dividend stocks offer another avenue for DRIP investors to explore. These stocks typically have higher than average dividend yields, making them attractive for income-focused investors. Examples include Realty Income Corporation, AbbVie Incorporated, and Verizon Communications. While high-yield dividend stocks may carry more risk compared to blue-chip or dividend aristocrat stocks, they make up an important part of the portfolio. Lastly, growth-oriented dividend stocks combine the benefits of capital appreciation and dividend income. These are companies with strong growth prospects and tend to keep increasing dividends to investors. Examples include technology giants like Microsoft, Apple, and Visa. If you're selecting stocks using these criteria, it'll narrow down the list of available stocks, so make sure your stock ticks at least 3 of the above 4 boxes. Based on the above criteria, I've selected the following 5 stocks to boost my portfolio. It includes NextEra Energy, Starbucks, Abbott Laboratories, The Home Depot, and finally, to combine them all, ProShares S&P 500 Dividend Aristocrats ETF. Separately, their current dividend yield, dividend growth, and share price appreciation look something like this. NextEra Energy Incorporated has a current dividend yield of 2.76%, a dividend growth rate of 10.98%, and an annual share price appreciation of 11.98%. Starbucks Corporation is at 3.01%, 16.69%, and 7.89%. Abbott Laboratories at 2.1%, 11.4%, and 10.31%. The Home Depot is at 2.59%, 17.91%, and 16%, while ProShares S&P 500 Dividend Aristocrats ETF has a current dividend yield of 2.04%, a dividend growth rate of 20.48%, and an annual share price appreciation of 8.17%. If we create a portfolio, our portfolio metrics might look something like this. You can calculate this by simply summing all the individual metrics, then dividing by 5. Do the same for current dividend yield, growth, and share price appreciation. With that, the portfolio has a current dividend yield of 2.5%, a dividend growth rate of 15.49%, and an annual share price appreciation of 10.87%. Now the question is, can this portfolio return enough over time for you to retire? Let's find out. If John invests $25 every week into this portfolio, which amounts to $100 per month or $1,200 per year, in this scenario, his investment strategy would unfold like this. At the end of the first year, John's weekly contribution is projected to reach $2,560. After 10 years, the same investment with weekly contributions and dividend reinvestment is projected to grow to $27,832. That's when the drip and weekly contribution starts compounding the effect. After 20 years, John's investment is estimated to reach $145,504. Fast forward another 10 years, and in 30 years, John's initial investment has the potential to soar to a valuation of $823,352. Alongside this impressive capital appreciation, he'll also receive $63,395 in dividends every year, translating to approximately $5,283 every month. In total, this portfolio has the potential to add $786,152 to his portfolio investment, with $464,535 attributed to the growth of the portfolio, while $321,617 came from reinvested dividends. That sounds good, but what if you have an initial investment? That's where our next strategy comes in. What if you invest $100,000 in the 3 best ETFs? When investors look for a top-flight dividend ETF to add to their portfolio, they usually start with a list of roughly a dozen commonly used funds. That list typically includes ETFs like VIG, VYM, and VOO. Other dividend ETFs exist, but the majority of analysis pieces tend to concentrate on this particular group. I've done it myself. But that doesn't mean they're the only ETFs worthy of your attention. In today's video, I'll show you and John 3 of the best ETFs you can invest in without worrying. I'll show you how they stack up and what their strategies are. I'll show you how much you and John can earn from a $100,000 investment in each of these ETFs alone. Fun fact, one of them has the potential to cross a $20 million portfolio return. And in the end, I'll show you how you can combine these ETFs to reduce risk and still manage excellent annual dividends and capital appreciation. Before jumping straight into discussing the ETFs, I want to outline my criteria for selecting these funds. When I choose exchange-traded funds, ETFs, for my investment portfolio, I have some rules. First, the ETFs should match what we want to do with our money, whether focused on income generation, capital appreciation, or a combination of both. I want the ETFs to have a mix of different kinds of investments, so we don't put all our eggs in one basket. Third, I like ETFs that don't cost too much, so that we can keep more of our money. Lastly, stability is important, which can be assessed by looking at how well the ETFs have performed in the past to see if they're good at making money. With these criteria in mind, let's begin by discussing the first ETF for today, Schwab U.S. Dividend Equity ETF, known by the ticker symbol SCHD. Launched in 2011, SCHD is a passively managed ETF designed to offer investors exposure to high-quality dividend-paying stocks in the U.S. market. With assets totaling over $52 billion, this ETF is one of the largest ETFs attempting to match the large-cap value segment of the U.S. equity market. Despite its size, it maintains a massively low expense ratio of just 0.06%, making it an attractive option for cost-conscious investors seeking reliable income and long-term growth potential. SCHD's stock selection process is based on a set of stringent criteria aimed at identifying financially robust companies with a solid track record of dividend payments. The ETF's holdings are filtered based on the following criteria. 1. Minimum 10 consecutive years of dividend payments. 2. Minimum float-adjusted market cap of $500 million. And 3. Minimum 3-month average daily volume of trading of $2 million. Once qualified, stocks are further ranked based on their dividend yield, 5-year dividend growth rate, financial health, and return on equity. This comprehensive evaluation process ensures that SCHD's holdings include companies with strong financial fundamentals and a consistent increase in shareholder value through consistent dividend payouts. Something we'll see in the upcoming chapter is the projection of how much it would return from a $100,000 investment. And in the end, I'll show you an ETF that has the potential to reach a valuation of $200 million with a one-time investment of $100,000. Back to SCHD. This ETF portfolio consists of 102 holdings, with the top 10 holdings making up approximately 41.84% of the fund. These holdings include well-known names such as AbbVie, Chevron, PepsiCo, Pfizer, Coca-Cola, Verizon, and Texas Instruments, among others. These companies are industry giants renowned for their stability, profitability, and ability to generate steady cash flows, making them reliable sources of dividend income for investors. Not every ETF or stock always does well, including SCHD. Even though SCHD didn't perform well last year, it's important to understand why. Sometimes, investors make quick decisions based on recent events or focus too much on losses instead of gains. Knowing about these biases can help investors stick to their long-term plans and avoid making hasty choices. Even though SCHD faced some problems recently, it still has strong points that make it a good choice for long-term investors. So what does this mean for a $100,000 investment in the long run? Let's run the numbers. SCHD has a current dividend yield of 3.38%, backed by a strong 10-year average dividend growth rate of 10.87% and a solid 8% share price appreciation average over the past 10 years. Based on these metrics, if John invests $100,000 in this ETF, after 1 year, his investment is projected to reach $111,380. After 10 years, the investment is expected to triple to $306,484. Yet, it's the dividend yield of SCHD that truly shines over time. After 20 years, John's investment is anticipated to grow to $1,050,609. And extending to 30 years, his initial investment has the potential to grow to $4,170,308. Notably, he'll receive a massive $276,825 in dividends annually, approximately $23,069 per month. In total, this ETF has the potential to add $4,070,308 to his initial investment, with $2,251,669 coming from capital appreciation, while an impressive $1,818,639 came from reinvested dividends, showcasing the power of consistent dividend reinvestment strategies. Now, if you think this is a good return, wait until you see the next two ETFs on the list. One of them has the potential to reach an over $20 million valuation. In the end, I'll show you with a portfolio how you can double the SCHD return and get over $40,000 in annual dividends. Next up, we have the Invesco QQQ Trust with the ticker symbol QQQ. This exchange-traded fund, ETF, offers investors exposure to a diversified portfolio of stocks. Like SCHD, this ETF also uses a passive management approach. Unlike actively managed funds, which rely on financial experts to hand-pick investments, QQQ aims to replicate the performance of its underlying index, the NASDAQ 100. This strategy helps keep fees low, around 0.2%. This is higher than SCHD, but once you see the historic performance and the return that I'll show you in the end, it all makes sense. The NASDAQ 100 index includes the top 100 companies listed on the NASDAQ Stock Exchange, predominantly in the technology and growth sectors. These companies represent some of the most innovative and dynamic players in the market, including industry giants like Apple, Microsoft, Amazon, and Alphabet. QQQ's portfolio also includes top-performing stocks in semiconductors, healthcare, and software sectors, providing investors with exposure to diverse growth opportunities. As for its historic performance, QQQ has a remarkable track record of delivering strong returns over the long term. With an average annual return of 10% over the past 3 years, 22.4% over the last 5 years, and an over 17% return over the past decade, QQQ has outpaced the broader market, including the S&P 500 index. Its consistent performance has solidified its position as one of the premier ETFs, managing a substantial $259 billion in assets. While QQQ's historic performance is impressive, investors must consider its valuation, especially in the current market environment. With some of its top holdings trading at high multiples of earnings and book value, there are concerns about overvaluation. Buying QQQ at peak prices could lead to prolonged periods of waiting for returns, reminiscent of historical market downturns. Therefore, cautious consideration of entry points is advised, balancing potential returns with valuation risks. Now, despite valuation concerns, Wall Street analysts maintain a generally positive outlook on QQQ, with a majority rating it as a moderate buy. Analysts foresee potential upside for the QQQ stock price, projecting an approximately 11.89% increase from current levels. This sentiment reflects confidence in QQQ's underlying assets and their long-term growth prospects, despite short-term market fluctuations. So, Wall Street analysts think this is a good ETF, and history suggests the same, but what does the future look like? Let's find out. QQQ has a current dividend yield of 0.55%, not the highest, but it has a good dividend growth rate of 9.93%. But this ETF is about capital appreciation, which can be seen from its average share price growth over the years of about 17.7%. Based on these metrics for QQQ, John's investment after the first year is expected to reach $118,250. After a decade, the investment is set to more than quadruple to $527,504. After 20 years, John's investment is forecasted to reach $2,731,723. Give it 10 more years, and in 30 years, his initial investment has the potential to grow to an impressive $14,030,517. paying $6,277 in annual dividends. In total, this ETF has the potential to add $13,930,517 to its initial investment, with $13,858,290 attributed to the growth of QQQ stock, while $72,227 came from dividends. These returns are extremely good, but can our first-ranked ETF do even better than that? Let's find out. We have the Vanguard Information Technology ETF, known by the ticker symbol VGT. Managed by Vanguard, this is one of the leading names in the investment management industry. Our first ETF, SCHD, is dividend-focused. The second, QQQ, is inclined towards tracking and outperforming the index, while VGT is solely here to make your investment grow. That is, this ETF is all about capital appreciation, something you'll see when, in the end, we run the future projections for this ETF. In fact, it's so growth-focused that it only invests in the tech sector. VGT sticks to a strict definition of information technology. For example, it doesn't invest in Amazon, viewing it as a retail company, nor in Google or Meta, which it categorizes as a communications company. This targeted approach aims to provide investors with exposure to the core of the tech sector, emphasizing innovation and growth potential. While VGT's expense ratio of 0.1% is double that of the average Vanguard ETF, it remains significantly lower than the average for similar technology-focused funds. Unlike some broader ETFs, such as Invesco QQQ, which includes non-tech companies, VGT remains true to its tech-focused mandate. This exclusive concentration on the tech sector makes VGT an attractive option for investors who believe in the long-term growth prospects of technology companies. Some people think you can get the same returns by owning VGT's top stocks individually, but VGT's performance shows that's not true. It focuses on a few key stocks, which helps it benefit from the great performance of new tech companies, even if it's mostly invested in a few big ones. This flexibility lets VGT do better than the overall market. While quantitative ratings should not be the sole basis for investment decisions, VGT holds a favorable strong buy rating from Seeking Alpha with strong scores across various categories. So, does this ETF have what it takes to cross the QQQ forecast? Let's find out. VGT has a current dividend yield of 0.7%, not the highest, but it does have one of the strongest dividend growth rates of 14.36% and an even better average share price appreciation of 19.13%. In the first year, John's $100,000 investment in VGT is projected to reach $119,830. After 10 years, the same investment is projected to multiply six-fold to $603,732. After 20 years, John's investment is forecasted to balloon to $3,578,687. Pushing even further to 30 years, his initial investment has the potential to skyrocket to a remarkable $20,975,390. Additionally, he'll receive $29,827 in dividends annually, translating to about $2,486 monthly. In total, this ETF has the potential to add $20,875,390 to his initial investment, with $20,632,836 coming from the growth of VGT, while $242,527 came from the dividends. Okay, now that you've seen the return from the three ETFs, here comes the portfolio of all three. Investing in these ETFs is a great opportunity, but like any investment, ETFs have risks, and you cannot put all the eggs in one basket. To minimize these risks, diversifying your investment is crucial. That's where the portfolio comes in. This well-diversified trio can potentially achieve diversification across different investment styles. This means your investment is not solely reliant on the success of any single sector or company. QQQ offers the potential for significant capital appreciation, while VGT prioritizes the cutting edge of technology. Meanwhile, SCHD strikes a balance between growth and income with a potential bias towards stability. If you choose the ETFs mentioned above and invest an equal amount in each, you can calculate some key metrics to assess your portfolio's performance. All you have to do is add the respective yield percentages and divide by 3, and you'll have your portfolio's average dividend yield, dividend growth, and annual growth. For our portfolio of these 3 ETFs, we get an average current dividend yield of 1.54%, a strong dividend growth of 11.72%, and an average annual growth of 14.94%. Let's say John invests $100,000 in this portfolio. After a year, this investment will be valued at $116,480. In 10 years, it's projected to quadruple to $451,710. Moving on to 20 years, this portfolio is projected to reach $1,975,972. And at the 30-year mark, John's initial investment of $100,000 is projected to reach an impressive $8,445,497, paying an annual dividend of $43,572 or approximately $3,631 monthly. In total, this portfolio significantly grows his investment by $8,345,497, which includes $7,951,990 from the rise in portfolio value and $393,507 from dividends. And now, here's the fastest way you can live off dividends. Picture a world where the daily hustle is no longer necessary. You're not tied down by the conventional work routine. Instead, you've got a financial plan that secures $2,700 every month. It's not magic, it's the smart use of dividends. You and John have invested, and now you're reaping the benefits. This money isn't just sitting there, it's multiplying, ensuring that you both have a comfortable income for life without additional work. That's the beauty of dividend income. In this video, we'll show you the 3 fastest ways to reach $2,700 a month, stacked from slightly risky to the safer investment option. So why pay attention? Here you'll not only learn what dividends are, but also how to make them your main income. This is for those who want more than just getting by. This is for those who dream of a life where money worries don't hold them back. The second reason is that according to the Bureau of Labor Statistics in 2023, the average monthly expenses for one guy was $3,693, or $44,312 annually. That's a hefty amount, and if you don't want to be succumbed by it, we're here to guide you along a path, one that many investors have taken to reach the land of passive income. So if you want a life where you have more time for yourself, stick around. So what are dividends? Well, think of them as your slice of the profit pie. When you invest in certain stocks, companies will pay out a portion of their earnings to their shareholders, and that is your dividend. Dividends aren't just a one-time deal, they're recurring payments, usually distributed quarterly or annually. And here's where it gets even better. You can reinvest those dividends to buy more shares, which means even more dividends down the line. Now, before you go all in on dividend stocks, there are a few things you need to know. Not all companies pay dividends, and even among those that do, the payouts can vary widely. Some companies like Apple or Amazon might accumulate their wealth, opting to reinvest it back into the business rather than distributing it among shareholders. So you gotta do your homework and find those reliable dividend payers. Now you're probably wondering, how much money should I put into this? Honestly, it all depends on your income, spending habits, and living expenses, which means the answer is highly personal. But once you know how much you'll need to live, here's a simple formula to apply to sort out how much you need in total. Desired dividend income divided by dividend yield. The dividend yield is the percentage of the share price paid out, and it can vary from company to company, even from year to year for the same company. You can calculate a dividends yield with this simple formula. Annual dividends per share divided by price per share. For example, if John owns a stock that pays $5 in dividends a year and has a price per share of $50, its dividend yield would be 10%. Now let's go with our $32,400 per year plan. Next, consider what you can reasonably expect from dividend yields. It's fair to plan on yield rates between 1% and 6%. Using our formula, here's how yields translate to what you'll need to get to $32,400 per year. 2% yields require a portfolio of $1,740,000. 3% yields require a portfolio of $1,160,000. 4% yields require a portfolio of $870,000. 5% yields require a portfolio of $696,000, and 6% yields require a portfolio of $580,000. This sounds good, but it's still over a $500,000 investment. Next, I'll show you how you can reach the same goal with a significantly smaller investment. These are the fastest ways to live off dividends and earn $2,700 per month. Let's start off with the first, high-yield covered call ETFs. These funds are a unique blend, offering investors a chance to get benefits from stock growth as well as dividend yields. How does it work? The fund invests in a collection of stocks and at the same time issues call options on those stocks, thereby creating an extra income channel. These call options provide a potential buyer the right, though not the obligation, to purchase a stock at an agreed price within a specified time frame. Thus, when the ETF dispenses call options tied to its stock holdings, it collects premium income, which is then allocated as dividends. Furthermore, if the stock value escalates beyond the call option's designated price, the ETF may accrue capital gains due to the obligatory sale of those stocks. There are several popular covered call ETFs to consider, such as QYLD, RYLD, and TLTW. These funds offer attractive yields, often in the double digits, which are significantly higher than the yields of many traditional dividend stocks. Let's take a look at their 12-month trailing yields. TLTW has a yield of 19.46%. RYLD has a yield of 12.16%. XYLD has a yield of 11.58%. The beauty of these ETFs is their dual income provision through dividends and option premiums, crafting a more robust and dependable income stream. However, know that there are risks involved, such as the potential for options to expire without value or a downturn in stock prices, which could influence the fund's performance. Now, how much will John need to invest in covered call ETFs to have $32,400 per year? Going back to our formula of dividend yield, we divide the required dividend income of $32,400 by an average yield of 14.4%, which comes to $242,000. That means John would need to invest this much in covered call ETFs to have $32,400 in annual dividends, or $2,700 in monthly income. For someone like John, who's set on a course toward financial independence through dividends, covered call ETFs could be the way. This investment strategy not only nudges him towards his annual financial goal, but also does so with a modest initial outlay. Now let's explore another strategy that could enable John to amass $32,400 per year or $2,700 per month through dividends, which is real estate investment trusts, or REITs. A REIT is an organization that owns, manages, or funds real estate that produces income. REITs are popular because of their income streams and tax advantages. They're taxed at a lower rate than traditional corporations, and their dividends are taxed as ordinary income at the shareholder level, making them attractive investments for income-oriented investors like John. For John, there are some great REITs to consider if he wants to earn passive income from dividends. These include Global Net Lease, which has a dividend yield of 18.29%, Invesco Mortgage Capital with a dividend yield of 16.91%, and Granite Point Mortgage Trust offering a dividend yield of 16.39%. These REITs have a track record of providing their investors with a consistent income stream through dividends. Historically, REITs have shown solid performance with an average annual return of 10.8% over the past 20 years. This means that investing in REITs can be a smart way for John to potentially grow his wealth while earning a steady income. It's important to know that the amount of money you get from REITs can go up and down because it depends on how many people rent the properties and how the economy is doing. While REITs can give you more money than regular stocks, they can also be risky when the economy is not doing well. So how much does John need to invest to earn $32,400 per year from REITs? If he expects to get around 10.8% each year, we divide $32,400 by 10.8% and come to $320,000. That means John would need to invest $320,000 to live off dividends with an investment in REITs. But this number can change depending on whether he chooses to put his money in different REITs or just one. A good way for John to retire with REITs is to save and invest a certain amount of money each week and let the dividends add up until he reaches his goal. If he stays committed and patient, he could become financially independent in about 5 to 7 years. When investing in REITs for dividends, it's important for John to have a plan. He needs to know how much money he requires and what he wants to achieve. This will help him choose the best REITs for his portfolio and make sure he sticks to his plan over time. Everyone's situation is different, so John might find that he can live happily with less than $35,000 per year. Or he might need more if he has a family or certain lifestyle preferences. One great thing about REITs is that unlike regular stocks, they often pay dividends every month. This makes them an even more attractive choice for people who want a steady income from the stock market. So, if John is ready to take a step toward financial independence, exploring the world of REITs is a smart move. It's a strategy that has the potential to make his dreams come true. Moving on to strategy number 3, Dividend Aristocrats. Dividend aristocrats are a special group of stocks renowned for their stability and consistent dividend payments. These esteemed stocks are often part of major indices like the S&P 500, boasting a remarkable history of increasing dividends uninterrupted for at least 25 consecutive years. Some of the leading dividend aristocrats include stalwarts like Altria Group, Leggett & Platt, and 3M Company. These industry giants typically offer dividend yields averaging around 7%, albeit slightly lower than some other investment options like covered call ETFs and REITs. Nevertheless, their consistent commitment to dividend payouts makes them a cornerstone of income-focused portfolios. They're characterized by their aggressive reinvestment strategies, where profits are often channeled back into the company to fuel further expansion. Deciding whether to invest in these stocks requires careful consideration of your investment objectives, time horizon, and risk tolerance. While dividend aristocrats span diverse sectors, they share common attributes like robust financial performance and enduring market presence. These are established entities with a proven track record of weathering economic turbulence, ensuring sustained profitability. Now, how much does John have to invest to meet his goal? Considering a 7% dividend yield and $2,700 required in monthly dividends, through using the formula, we get around $39,000, translating to $463,000 annually. So, John has to invest $463,000 to be completely independent. Though it may be the largest investment of our three options, compared to traditional dividend stocks, which would need an investment of $2 million, this is a fraction but with the same payout. A good idea for John is to spread his investment across multiple dividend aristocrats to reduce risk. With a proven track record of delivering sustained returns, John has the potential to receive regular income from his investments. The fastest way is good, but it demands a huge investment. What if you have a small starting investment? That's where our next strategy comes in, the dividend snowball. Ever seen a tiny snowball rolling down a hill? What happens? It gathers more snow, right? And before you know it, it's turned into this massive, unstoppable force of nature. Big names in investing, like Warren Buffett, use something called dividend snowball. But instead of snow, this ball is made up of dividend payments from different stocks in your investment portfolio. As it rolls down the hill of time, it gathers more dividends, compounding its growth exponentially. So how does this whole thing work? And more importantly, how can it help you earn $5,000 in monthly income? In this video, I'll show you two strategies, a one-time investment and a monthly investment of $200 to reach a $5,000 per month goal. In the end, I'll show you a portfolio of stocks that has the potential to triple that return over the long run. So what exactly is the dividend snowball effect? Well, it's simpler than you might think. When a company pays out dividends, you use that money to buy more shares of the stock. These additional shares mean you'll get even bigger dividend payments next time around. This compounding effect causes your investment to grow exponentially over time, much like a snowball growing as it rolls downhill. In other words, the growth isn't linear, it's exponential, meaning it accelerates over time. The key is patience and reinvestment. Set up your investments with dividend-paying companies, then sit back and let your dividends grow and compound your portfolio over time. Just like a snowball gains size and momentum, your investments will grow too. But truthfully, understanding the concept is one thing, actually putting it into practice is another. So let's get into some real strategies that you can use to set your dividend snowball rolling. The first step starts with setting a goal of monthly dividends. And everyone's investment journey is unique. Some people want to make $1,000 a month, while others may want to earn $5,000 per month. When planning how to invest or diversify your portfolio, it's important to consider your individual financial situation and what makes the most sense for you. For this video, John will explore two strategies to determine if they can help him make $5,000 or more a month after retirement. Setting a goal gives you a target to work towards. It also allows you to measure your progress and adjust your strategies as needed. The key here is to be realistic about your timeline and the amount you can invest. Now that we have a goal, we need to determine what kind of return in stocks we should be looking for to reach that goal. Which brings us to the next chapter, my two strategies to reach the $5,000 goal. To reach the goal of $5,000 per month after retirement, you need to strategically select stocks that offer a combination of high dividend yield, consistent dividend growth, and solid share price appreciation. These three elements work together to maximize the compounding effect of your investments. Let's get to know the two strategies that can help you achieve this. Strategy 1, John makes a one-time investment of $10,000. Obviously, this strategy demands that one-time investment of $10,000. John has to put it into a stock that meets the following criteria: a current dividend yield of 8%, a dividend growth rate of 7%, and an annual share price appreciation of 6%. Over time, these factors will work together to grow John's investment and his dividend income. Here's how it plays out. After 1 year, his $10,000 investment would grow to $11,400. After 10 years, it would be worth $38,292. After 20 years, it would grow to $158,245. By the end of 30 years, John's initial $10,000 would have reached $710,970. The dividends alone after 30 years would amount to $65,055 annually, which breaks down to about $5,421 per month, meeting our goal. Now let's consider a different approach. Instead of a one-time investment, John decides to invest $200 every month into a similar high-yield, high-growth stock. This strategy leverages the power of regular contributions and compounding dividends over time. With this method, John's consistent monthly investments would look like this. After 1 year, John's invested $2,400. After 10 years, John's investment grows to $47,548. After 20 years, it reaches $246,150. By the end of 30 years, John's total investment would be worth $1,158,011. The annual dividends after 30 years would be $105,740, which translates to about $8,812 per month. Impressive, right? Now remember, at the end, I'll show you how to earn double or triple that amount in dividends with a portfolio of stocks. So we can clearly see that the second strategy has a better output than the first. The reason is that this strategy benefits from the steady, consistent growth of your investments and takes advantage of market fluctuations by spreading your investments over time. It's a great option for those who might not have a large sum to invest initially but can commit to regular contributions. However, there's one big problem here. Finding a single stock that consistently pays over 8% in dividends each year can be challenging. In fact, I don't even recommend stocks that pay dividends above 7%. That's because of the dividend trap. Many new stocks tend to attract investors with significantly high starting dividend yields, and these kinds of companies, in the end, tend to fail, and investors end up losing money rather than gaining it. To address this, I have a solution. Like I said in the beginning, to reach a goal of $5,000, you need a good mix of dividend yield, dividend growth, and share price appreciation. Here's how you do it. In the coming chapter, I'll show you how to create a diversified portfolio that balances high-yield stocks with growth potential, ensuring stability and maximizing returns. So let's talk about making a portfolio. To achieve the goal of earning $5,000 a month in dividend income, it's crucial to create a diversified portfolio that includes different types of high-yield investments. This ensures stability, growth, and consistent income. Let's make an ideal portfolio by focusing on 3 tiers of investments: dividend aristocrats or kings, strong and stable dividend ETFs, and dividend-paying REITs. In the end, I'll show you whether this powerhouse of a portfolio can earn you more than $5,000 in dividends per month or not. Back to making the portfolio. First, let's start with dividend aristocrats or dividend kings. These are companies that have a long history of consistently increasing their dividends. They've been raising the money they pay to investors for at least 25 or 50 years. Based on my research, here are some of the best dividend aristocrats or kings. The first one is Cintas Corporation. It has a current dividend yield of 0.78%, but what really stands out is its impressive dividend growth rate of 21.5% and a 10-year average share price appreciation of 27.07%. Other strong candidates are Abbott Laboratories and Bank of America. Here are the key metrics for each stock. So when we average out the metrics for these stocks, we get a current dividend yield of 1.78%, a dividend growth rate of 23.44%, and a 10-year average share price appreciation of 15.67%. These metrics provide a strong foundation of growth and income stability for your portfolio. Next, let's add strong and stable dividend ETFs to our portfolio. These funds allow you to invest in a basket of high-yielding stocks, offering diversification and ease of management. Some of the solid options in dividend ETFs include the Vanguard Information Technology Index Fund ETF shares, Schwab U.S. Dividend Equity ETF, and the Vanguard Mid-Cap Index Fund ETF shares. By averaging the metrics for these high dividend ETFs, we get a current dividend yield of 1.87%, a dividend growth rate of 12.58%, and a 10-year average share price appreciation of 11.54%. Finally, let's include dividend-paying REITs. Real estate investment trusts are required to distribute at least 90% of their income as dividends, making them a fantastic source of high dividend yields. American Tower Corporation is a prime example, offering a current dividend yield of 3.34%, a dividend growth rate of 18.83%, and a 10-year average share price appreciation of 8.16%. And then there's also CubeSmart and Rexford Industrial Realty. Averaging the metrics for these dividend-paying REITs gives us a current dividend yield of 3.91%, a dividend growth rate of 16.99%, and a 10-year average share price appreciation of 9.81%. These REITs add a significant high-yield component to our portfolio, enhancing both income and growth potential. Now, if you're wondering where I get all that data, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive data-based stock ratings have been a game-changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%, so definitely check them out in the description, seeing as they've also promised to give a 20% discount on premium membership with a 7-day free trial at a 10% discount on alpha picks to those in our community who join using the link from the video description. Okay, back to portfolio returns. Combining the metrics of all the tiers, our portfolio averages out to a current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%. This balanced mix of stocks, ETFs, and REITs ensures that our portfolio is well diversified and poised for both income generation and capital appreciation. Now that we've established a diversified portfolio, let's get into the detailed projections to see how our investments can grow over time. I'll show you both the one-time investment strategy and the monthly contribution strategy, then determine which one is the best approach to go for. First, let's start with strategy number 1, the one-time investment strategy. Based on a current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%, if John invests $10,000 in this portfolio, after 1 year, the investment would grow to approximately $11,486. After 10 years, his investment would be worth about $42,456. At the 20-year mark, John's investment would grow to roughly $217,450. By the end of 30 years, John's initial $10,000 would have ballooned to an impressive $1,514,523, paying around $139,020 in annual dividends. This translates to a monthly dividend income of approximately $11,585. The total value added to John's investment over 30 years would be $1,504,523, with $867,217 coming from capital appreciation and $637,305 from reinvested dividends. This projection highlights the extraordinary growth potential of a well-diversified portfolio. But can strategy 2 beat these numbers? Let's find out. In this scenario, John invests $200 every month into the same diversified portfolio. After the first year, John's total investment would be $2,400. After 10 years, it would grow to about $50,687. After 20 years, John's monthly contributions would accumulate to approximately $316,483. By the end of 30 years, his total investment of $72,000 would grow to a staggering $2,273,335. At this point, the annual dividend income would be around $208,452, providing a significant monthly income of about $17,371. The total value added to John's investment would be $2,201,335, with $1,261,355 from capital appreciation and $939,980 from reinvested dividends. Next up, I have this strategy completely at work with the 3 best REITs. Ever wondered how to transform $10,000 into a $1 million investment portfolio? What if I told you that this investment could potentially grow to $5 million? Sounds like a dream, right? Well, this dream can become a reality with 3 solid dividend REITs. In this video, I'll show you and John 3 of the absolute best REITs currently on the market. I'll break down their business models, financial performance, and future prospects to understand how these investments can help you achieve your financial goals. I'll show you a REIT that has the potential to pay over $80,000 in monthly dividends. And in the end, I'll show you a portfolio of the 3 best REITs that has the potential to make John a multimillionaire and pay over $350,000 in annual dividends. Now, before we get into the specifics of each REIT, let's talk about how I selected them. Investing isn't just about picking popular names, it's about making informed decisions based on solid criteria. Here's how I chose my top 3 REITs. First, I look at dividend yield. A high yield means you're getting a good return on your investment right from the start, but it's not just about the yield today. You also have to consider dividend growth. Consistent growth indicates a REIT's ability to increase payouts over time, which is crucial for long-term investors. After that, you need your investment to also grow in value by means of share price appreciation. For this, you also have to consider the 10-year average share price appreciation. Based on these criteria, coming up next are the 3 best REITs ranked from the good to highest value addition to your portfolio. Starting at number 3, we have Extra Space Storage. Known by the ticker symbol EXR, Extra Space Storage is a fascinating player in the world of REITs. This company has carved out a niche in the self-storage industry. Now, you might be thinking, self-storage? Really? But this sector has been booming, and EXR is leading the charge. Extra Space Storage operates over 3,500 facilities across 43 states, making it one of the largest self-storage companies in the U.S. Their business model is simple, yet highly effective. They provide secure, clean, and convenient storage solutions for both personal and business needs. So, let's dig into the numbers. EXR currently has a dividend yield of 4.33%, which is quite impressive. But that's not all. The real return lies in their dividend growth rate, which stands at a robust 15.01%. This means your dividend payouts are not only stable but also growing significantly over time. And there's more. When we look at the 10-year average share price appreciation, EXR shines with an impressive 10.9%. This indicates that the stock price has been growing steadily, adding substantial value to your investment. To give you a clearer picture, let's look at the future projections. If John invests $10,000 in EXR today, in 1 year, his investment is projected to grow to $11,523. Not bad for a year, right? Fast forward to 10 years and you could be looking at $44,578. Keep that investment for 20 years and it could grow to a nice balance of $247,814. And if you're in it for the long haul, after 30 years, your initial $10,000 investment could balloon to an astounding $1,899,993. That's almost $2 million from a starting investment of $10,000. And let's not forget about the dividends. After 30 years, you'd be receiving $212,120 annually in dividends, or about $17,677 every month. The total value added to your investment would be around $1,889,993, with $909,660 coming from capital appreciation and $980,333 from reinvested dividends. It's clear that EXR not only offers solid immediate returns, but also positions you for significant long-term gains. Analyst sentiment is also in our favor. The quant rating for EXR is a solid buy, which is also backed by Wall Street analysts. Even Seeking Alpha analysts give it a hold, indicating a general consensus of its strength and potential. These ratings reflect confidence in EXR's business model, growth prospects, and overall market position. Next up, at number 2, we have another promising REIT, Rexford Industrial Realty, known by its ticker symbol REXR. This REIT focuses on industrial properties, specifically in the Southern California market. Now, why is that a big deal? Southern California is one of the most dynamic and high-demand industrial markets in the world. With the constant stream of goods flowing through places like the ports of Los Angeles and Long Beach, it's a logistics powerhouse. Rexford Industrial owns and operates a huge portfolio of high-quality industrial properties, including warehouses, distribution centers, and light industrial facilities there. These assets are strategically located near key transportation hubs, making them extremely valuable for businesses that need to move products quickly and efficiently. This prime real estate positioning not only ensures high occupancy rates, but also allows Rexford to command premium rents. As for the investment metrics, the current dividend yield for Rexford Industrial is 3.79%, which might seem modest compared to some high-yield REITs, but it's the growth that really matters. REXR has an impressive dividend growth rate of 16.79%. This rapid growth indicates that the company's not only committed to rewarding its shareholders, but is also generating increasing amounts of cash flow to support these payouts. Looking at the historical performance, the REIT's 10-year average share price appreciation is an outstanding 12.09%. So what does this mean for your investment? If John put $10,000 into this REIT today, his investment is projected to grow to $11,588 in 1 year. Over 10 years, that investment could grow to $47,209, which more than quadruples the initial amount. Fast forward 20 years, and you could be looking at $280,989. And if you're thinking really long-term, after 30 years, that $10,000 investment could potentially grow to an impressive $2,387,661. Paying $271,115 annually in dividends, which translates to about $22,593 every month. To break it down, the total value added to your investment would be around $2,377,661, with $1,195,802 coming from capital appreciation and $1,181,859 from reinvested dividends. If you think this is good, wait till you see the top REIT that has the potential to double this valuation. And in the end, I'll show you a portfolio of the 3 best REITs that has the potential to make John a multi-millionaire and pay over $350,000 in annual dividends. Analyst sentiment further reinforces the strength of REXR. The quant rating is a hold, indicating cautious optimism. However, Seeking Alpha analysts rate it as a buy, and Wall Street analysts also give it a buy rating. This positive outlook from experts suggests confidence in Rexford's ability to continue delivering strong performance and shareholder value. Okay, quick reveal. If you're wondering where I get all that data from, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive database stock ratings have been a game changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%. So, do yourself a favor and check them out in the description. As a bonus, they've promised to give a 20% discount on premium membership, with a 7-day free trial and a 10% discount on alpha picks to those in our community who join using the link from the video description. Now, back to our video. Let's take a look at our top REIT pick, CubeSmart. This REIT has some impressive numbers and a solid business model that you'll definitely want to know about. Known by its ticker symbol, CUBE, CubeSmart is a leader in the self-storage industry, operating a massive network of storage facilities across the United States. The company's business model is centered on providing convenient and secure storage solutions for both personal and business needs. Whether you're looking to store household items, business inventory, or even vehicles, CubeSmart has a facility to meet your needs. CubeSmart's extensive reach with hundreds of locations strategically placed in high-demand areas ensures a steady flow of customers and, consequently, a robust income stream. Their focus on customer service and facility maintenance has earned them a strong reputation, which translates into high occupancy rates of about 90% and the ability to command premium rents. Let's break down the financial metrics that make CubeSmart an attractive investment. CubeSmart currently offers a dividend yield of 4.8%, which is quite compelling, backed by a strong dividend growth rate, which stands at an impressive 15.34%. And with a 10-year average share price appreciation of 8.69%, it becomes clear why CubeSmart is a top choice. This figure indicates steady growth in the value of your investment, adding another layer of return on top of the dividends. Listen, a company that can grow its share price consistently over a decade and maintain a good starting dividend yield is a strong candidate for long-term investment. Now let's talk about projections. If John invests $10,000 in CubeSmart today, that investment is expected to grow to $11,349 in 1 year. This initial growth is promising, but the long-term projections are where CubeSmart truly shines. Over 10 years, the same investment could grow to $41,190. Fast forward 20 years, and you might be looking at $279,104. And if you're in it for the long haul, after 30 years, your initial $10,000 investment could balloon to an astounding $4,571,595. Paying $1,015,882 in annual dividends, which breaks down to approximately $84,657 per month. The total value added to your investment would be around $4,561,595, with $1,158,911 coming from capital appreciation and $3,402,684 from reinvested dividends. So the question is, should you just invest all your money in Cube? The answer to that is no. Investing in these REITs is a great opportunity, but like any investment, stocks have risks, and you cannot put all of your eggs into one basket. To minimize these risks, diversifying your investment is crucial. That's where the portfolio comes in. If you choose the REITs mentioned above and invest an equal amount in each, you can calculate some key metrics to assess your portfolio's performance. All you have to do is add the respective yield percentages and divide by 3, and you'll have your portfolio's average dividend yield, dividend growth, and annual growth. For this portfolio, we'll get an average current dividend yield of 4.31%. A strong dividend growth rate of 15.71%, and an average annual growth rate of 10.56%. So based on these metrics, let's say John invests $10,000 in this portfolio of REITs. In 1 year, this investment is projected to grow to $11,487. Over 10 years, it has the potential to grow to $44,161, which more than quadruples your initial amount. Fast forward 20 years, and you could be looking at $263,812. In 30 years, the $10,000 investment has the potential to reach a value of $2,546,624 and pay $365,023 in annual dividends, which breaks down to about $30,419 every month. Not quite over $80,000 like our last REIT, but definitely safer than investing everything in one stock. In total, the total value added to your portfolio after 30 years would be around $2,536,624. This includes $1,036,689 from capital appreciation and a solid $1,499,934 from reinvested dividends. Want to make a portfolio but don't know how to compound and grow your portfolio? Here are the 3 fastest ways to compound your portfolio. Compounding is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Compounding is the magic of making more money from the money you already have. Think of it as planting a seed that grows into a tree, then using the seeds from that tree to plant more trees. The more trees you have, the more seeds and fruits you get, and the faster your money grows. In this video, we'll show you 3 ways to identify those compounding methods that can boost your returns and make you wealthier. One that'll increase your value by 30 times, one that'll increase your portfolio value by 70 times, and in the end, we'll show you a compounding strategy that'll boost your portfolio 140 times and add over $1 million to your portfolio. Let's get right into it. The first way to compound your portfolio is by investing in companies with high ROIC. These are the companies that reinvest their cash flow wisely and have a high ROIC, or return on invested capital. This metric shows how good a company is at turning its money to make more money, just like how many apples a tree can produce from one seed. For example, if a company has taken a loan from a bank with 10% interest, its cost of capital is 10%. Now, on that loan, the company makes a return of 15%. This 5% difference is the ROIC. The higher the ROIC, the more cash the company is getting in. If a company reinvests its cash flow at a high ROIC, it means it's using its money to grow its business and make more profits. ROIC not only reflects a company's operational efficiency, but also its ability to provide attractive returns to its shareholders. Now that you know the importance of ROIC, you need to find stocks with a high ROIC. One way is to look for companies that have a high growth in their revenue and gross profit. Both revenue and gross profit indicate how well a company is performing in its market and how much value it's creating for its customers. To help you find such companies, here's an example of 4 stocks: Apple, Cisco, Nike, Expeditors. You can see these companies have high ROIC and growth numbers, showing they're using their cash flow efficiently and effectively to grow their business and value. Let's look at how Expeditors is doing. The company provides logistics and transportation services and has a high ROIC of 25.7%, which means that it's generating a lot of profit from its global network and operations. And these numbers are further reflected in their investment parameters like dividend, dividend growth, and most importantly, share price growth. EXPD has a current dividend yield of 1.09%, backed by a 10-year dividend growth rate of 13.18% and an average annual share price increase of 11.36%. If John invests $10,000 in a stock with a strong return on invested capital, ROIC, at the end of the first year, his portfolio will be valued at $11,246. The same portfolio after 10 years will be valued at $32,631. Now the compounding effect, thanks to the company's high ROIC, can be seen. After 20 years, the portfolio will reach $108,734. And in 30 years, the same portfolio will be valued at $371,511. This means that in 30 years, the high ROIC stock has added $315,704 in capital appreciation and $45,807 in dividends to John's portfolio. Now, these numbers double and triple with coming strategies. In the end, we'll show you a strategy that will make you a millionaire with one stock. Before adding a company to your investment list, check if they're buying other companies. This is called acquisition. Some companies buy others to protect themselves or grow, but not all acquisitions are good. If a company buys a lot to protect itself, it might mean it can't grow on its own. This can slow down your investment too. It's better if a company has good profits to make money and grow. So watch out if a company is more focused on avoiding losses than winning in the market. Defensive moves can only do so much. It's the aggressive moves that bring big rewards. The next way to compound your portfolio is to add companies that use cash flow for buybacks. Now for the second way of compounding your portfolio. We look at buybacks. This is a financial strategy by the corporations to reduce their number of shares in the market by buying it from the market. When a company buys back its own shares, there are less shares to divide the profits among, so each remaining share becomes more valuable. By using a buyback strategy, the company is saying, "We believe our shares are undervalued." This can make your shares worth more over time as there are fewer of them to go around, and your piece of profit gets bigger. For example, a company has 1 million shares outstanding, earns $2 per share, and trades at $30 per share. It has a price-to-earnings ratio of 15. That is $2 per share times 15, which equals $30. But what happens if this company buys half of its shares back? Its earnings per share will become $4. If the market continues to value the company at 15 times earnings, the stock price should trade up to about $60, a big jump in capital gains for you. But if you remain in a stock where buybacks are high, it's important to assess the overall health of the company, since a decline in earnings will ultimately take the shares down. Also important is to look at the stock buybacks relative to the cash flow the company is generating from operations. Some of the best buyback companies to look at are W.R. Berkley, Alphabet, MasterCard, Tractor Supply Company. Let's dissect W.R. Berkley's current buyback yield, which stands at 2.92%, signaling an active effort to repurchase its shares and suggesting the company's confidence in the undervaluation of its stock. That means your investment now would be more than just fruitful. Examining the recent performance, there's been a 4.89% dip in the stock price over the last year, indicating a potential decline in investor confidence or challenging market conditions. However, taking a broader perspective, the stock has exhibited a quick 117.62% increase over the past 5 years, showcasing a positive long-term trajectory. The 10-year picture is even more appealing, with an impressive growth of 265.21%, suggesting that Berkley's strategic moves, including share buybacks, have contributed significantly to shareholder value over the past decade. For your portfolio, a company with high buybacks is good, but then at the same time, you need to be wary of the companies that pay down debt like there's no tomorrow. Paying it down too aggressively might not always be the super move you think it is. Debt can be a useful tool to finance growth and create value. For example, if a company borrows money at a low interest rate and invests it in a project that has a high ROIC, it can increase its earnings and value. However, some companies pay down debt too aggressively, even when it's not necessary. This can be a mistake because it means that the company is using its cash flow to reduce its liabilities instead of increasing its assets. Instead of paying down debt too aggressively, you should look for companies that have good debt management and high interest coverage. These companies can balance their debt and equity and use their cash flow to invest in profitable projects that can compound their portfolio quickly. Now John is looking for some good buyback stocks and finds W.R. Berkley stock is a good choice and invests $10,000 into W.R. Berkley. Like our last example, he wants to hold this one for 30 years as well for capital appreciation. The stock has a current dividend yield of 0.3%, backed by a 10-year average dividend growth rate of 9.51%. And most importantly, the stock has a strong 10-year average annual share price increase of 15.25%, thanks to consistent share buybacks. Based on these metrics, if John invests $10,000 in this stock with a strong buyback strategy, after just 1 year, his initial investment would be worth $11,555. Fast forward 10 years, and that same portfolio would quadruple to $42,188. After 20 years, the portfolio would have expanded to an impressive $176,386. By the time 30 years have passed, the value of the same portfolio would have surged to $733,782. In simple words, over the course of 30 years, the high share buyback meant more profit share and share price appreciation for John, which would have contributed $719,845 in capital appreciation, significantly compounding the value of his portfolio. Now we move to our final strategy to compound your portfolio: finding those companies that use their cash flow to pay their dividends and make you a millionaire. Dividends are important for your portfolio because they can help you earn more money without having to sell your shares. You can use your dividends to buy more shares of the same company or invest in other companies that can compound your portfolio quickly. This way, you can increase your number of shares and your dividend income over time. Remember that high-flying smartphone company with a killer ROIC we talked about earlier? Now you can take those dividend dollars and plow them right back into that company. It's like doubling down on a sure bet. So here's the grand scheme of things. You are in this cool compounding cycle. The dividends buy you more shares. The company keeps growing. Your shares get more valuable, and the cycle continues. It's like building a snowball of money rolling down a hill. It starts small, but it gets massive as it rolls. Now, some of the companies that you can add to your watch list are Visa Incorporated, Verizon Communications, PepsiCo, Johnson & Johnson. These are the companies that pay you a nice chunk of their profits, grow their dividends over time, and use their capital efficiently to generate more profits. Let's focus on Visa Incorporated, known by the ticker symbol V. This stock has a current dividend yield of 0.8%, backed by a strong average dividend growth rate of 18.33% and an annual share price appreciation of 16.8%. This means if John puts $10,000 into this stock, after 1 year his money grows to $11,760. In 10 years, it will increase five-fold to $50,924. This happens because the company behind the stock is great at making profits, and that helps John's money grow faster. In 20 years, John's money becomes a whopping $263,660. And after 30 years, it's even bigger at $1,393,000. In those 30 years, this stock added $1,284,076 in capital appreciation to John's portfolio and a dividend reinvestment of $98,924, all with an initial investment of just $10,000, and by selecting a good compounding stock to compound his portfolio. These compounding stock selections will help you find the best stocks for portfolio growth. Want to know all the basics of investing? Here's dividend investing for beginners. Warren Buffett once famously said, "Investment in knowledge pays the best interest." And when it comes to the world of finance, dividend investing is one of the smartest strategies that can yield massive rewards. If you're a beginner looking for a step-by-step guide from knowledge to real-life examples, you've come to the right place. In the next few minutes, I'm going to walk you through the essentials of dividend investing. We'll explore what dividend stocks are and how they can benefit you. But that's just the tip of the iceberg. I'll discuss different strategies you can adopt in dividend investing, whether it's focusing on growth, capturing dividends, or reinvesting your earnings. You'll have a strategy that suits your goals. I'll guide you through the step-by-step process of starting your own dividend portfolio, from choosing the right brokerage account and setting up a broker account to selecting the best dividend stocks that have the potential to make you a millionaire. In the end, we'll show you stocks that have the potential to pay over $50,000 in annual dividends with only $10,000 of initial investment. Remember, this is not a sprint, but a marathon. Building wealth through dividends takes time and patience. So stay tuned, grab a notebook, and let's start on this financial adventure together. Let's start by understanding what dividend investing is all about. Dividend stocks are an exciting aspect of the stock market, providing investors with a unique opportunity to earn from their investments. Simply put, a dividend stock in general represents a share in a company that pays out a portion of its earnings to its shareholders. These payouts are known as dividends. Generally, companies that offer dividend stocks are well-established and financially stable with a consistent record of sharing profits with their investors. To understand how dividend stocks work, let's consider a simple example. Imagine you buy 100 shares of a company, with each share priced at $10. This means your total investment is $1,000. Now, suppose this company pays 50 cents in dividends per share annually. Owning 100 shares, you'd receive a total dividend of $50 for that year. This equals a dividend yield of 5% on your investment. So, in essence, you're earning a passive income of $50 simply by holding these shares. The benefits of having dividend stocks are multiple. Firstly, it provides a regular income stream. Unlike investing in stocks solely for price appreciation, which can fluctuate unpredictably, dividends offer a more stable and predictable return. This makes dividend investing particularly appealing to those seeking a steady income, like retirees. Also, on the plus side, dividend investing can be less risky compared to other types of stock investments. Since dividend stocks are often from established companies, they tend to be less volatile in the stock market. Moreover, passive income from dividends can be a reliable source of cash flow, especially during economic downturns when the stock prices may fall. Now that you know what dividends are, you need to set goals for your stock investment. When starting on your journey in dividend investing, the first critical step is to clearly define your financial goals and understand your risk tolerance. Each investor's goals are unique and can range from building a retirement fund to generating a steady stream of income. For instance, if your goal is to create a safety net for the future, you might lean towards a more conservative approach, focusing on stocks with stable dividends. On the other hand, if you aim to accumulate wealth over time, you might opt for stocks with the potential for both dividends and capital appreciation. Understanding your risk tolerance is equally crucial. This simply means how much risk you're comfortable taking on. If the thought of your investments fluctuating in value makes you anxious, you likely have a low risk tolerance and might prefer investing in well-established companies with a consistent dividend-paying history. Likewise, if you're comfortable with some level of risk for the chance of higher returns, you might diversify into some growth-oriented dividend stocks. Speaking of which, diversification, in simple words, means not putting all of your eggs in one basket. It's about spreading your investments across various sectors and companies to minimize risks. While I will dive deeper into the importance of diversification in the upcoming chapters on how you can earn good dividends and also gain from capital appreciation of your investment, it's crucial to understand that a well-diversified portfolio can help shield you from market volatility and specific sector downturns. Now that you've set a goal, you need a strategy to reach that goal. This will determine how much investment you would need to invest in particular stocks. In the coming chapter, I'll show you how I research stocks for my portfolio and the metrics I look for investment using a broker. And also, in the end, I'll show you stocks that can make you a millionaire and pay over $50,000 in dividends. So stay tuned for that. Now, back to the strategies. When it comes to strategies in dividend investing, you have the option to think long-term or short-term. Short-term investing generally requires a significant amount of capital to make substantial gains in a shorter period. However, it also comes with higher risks and the need for constant market analysis. This means that if you have a high risk tolerance mindset, you're more likely to opt for this strategy. That is, your goal is capital appreciation and you want to achieve it in the short term. So your strategy might involve choosing stocks whose prices are likely to rise in the short term and gaining capital appreciation from that. However, this also means you have to invest a significant portion up front. Let's say you want to use the short-term strategy in dividend investing. If you want to invest $1,000 and invest in a stock that grows by 10% on average each year, your investment would increase by $100 in the first year, making your total $1,100. This is good, a 10% return, but again, it's only $100 in 1 year. So if you want to earn close to, let's say, $10,000 from the same stock, you have to invest around $100,000 in starting investment. And this figure will only go up if you've set a higher goal. On the other hand, dividend stocks also give you a second option in the form of long-term investment, which can be more accessible and less stressful. For example, with an initial investment of $10,000 in a diverse range of dividend stocks and a strategy focused on companies with a history of stable and growing dividends, you can start building a solid portfolio. This approach might not give you immediate large returns, but it's about growing your wealth steadily and sustainably. Let me provide you with some numbers. Let's say you invest in a stock that pays a dividend yield of 4% and has a dividend growth rate of 5% per year. If you invest in this stock and wait for 30 years, reinvesting the dividends paid by the company, by the end of those 30 years, your investment portfolio will be valued at $125,463, paying an annual dividend of $17,737. So you've achieved the same, or in this case, even better results than a short-term strategy with only a $10,000 investment. What can make a long-term strategy even more effective is the power of compounding. If you were to add a monthly contribution of just $100 to your investment, this consistent addition not only boosts your investment amount over time, but also allows you to purchase more shares, which can lead to more dividends. This strategy of reinvesting dividends and adding a small regular contribution can significantly add to the growth of your portfolio over the years. Referencing the above example, with a $100 monthly contribution, after 30 years, your portfolio will be valued at $330,702, paying an annual dividend of $46,582. That's an extra $200,000 in profit compared to our first example, even though you would only contribute $36,000 in monthly contributions over 30 years. And to top it off, it's not too stressful on your wallet. And that's why on this channel I focus on more long-term investment options so that everyone can start with even a small budget. You might have a different strategy and goal, but that's totally up to how you want to reach the common end goal of making a profit. But one thing that both strategies need is to take the next step and select the right broker platform, because your dividend investing journey begins with selecting the right brokerage platform. For today's video and our step-by-step beginner's guide, I'm teaming up with the brokerage service Moomoo. Special thanks to Moomoo for sponsoring this video. They've been following us, and as a mutual benefit deal, they've generously offered 15 free stocks to anyone signing up through this partnership. It's an incredible opportunity because it'll give you exposure to the stock market with no risk. With this offer, you can even sell the free stocks you receive, make a profit, and withdraw it to your checking account, essentially earning money in the stock market without any initial risk. But please note that you need to hold the money for 60 days before withdrawing in order to earn these returns. Now, you might be wondering why I've chosen Moomoo and if it's a safe platform. Look, I get it. The name can be a bit amusing, but let me clarify what Moomoo is, because it's more than just a brokerage. It's an app that allows you to trade stocks, options, and ETFs from your laptop, iPad, or your phone. What sets Moomoo apart is that they don't charge any commission fees, unlike some other brokerages that do. They're also a member of the SEC, FINRA, and SIPC, which means Moomoo users are insured up to $500,000 in their accounts. Regarding the app itself, whether you're on a computer or phone, it has a user-friendly interface. To top it off, Moomoo sweetens the deal with an impressive 5.1% APY, plus an additional 3% APY interest valid for 3 months on your uninvested cash in the US. New eligible users can enjoy a total interest rate of 8.1%, and that's not just limited to the US. In the Australian market, Moomoo also offers a competitive 6.8% interest rate. So even if you're not actively investing, you can still earn some extra income. But it doesn't stop there. If you're a new user, you can get up to 15 free stocks with signups in the US. Now, to get started and take advantage of these offers, use the link in the description below the like button. Signing up for Moomoo is a straightforward process. First, you need to click the link in the description of this video. It will take you to the registration page. On the registration page, you'll be guided through a simple registration process requiring basic personal information and identity verification. Once your account is set up, depositing money is just as easy. Connect your bank account to transfer funds securely into your Moomoo account. With your account funded, you're now ready to start exploring investment options and diving into the world of trading and dividend investing. Now that you have a trading app, let's begin with dividend investing. Getting started with dividend investing is an exciting phase as you begin to build your portfolio. One of the first steps is finding dividend-paying stocks. Before you start investing in dividend stocks, here are a few final tips to keep in mind. Dividend investing is not about quick gains. Rather, it's a strategy for steady growth over time. For instance, if you invest in a company with a strong track record of paying dividends, the real value comes from holding on to that investment for many years. Over time, not only do you benefit from the ongoing dividends, but you also stand to gain from the potential appreciation in the stock price. It's like planting a tree. The true reward comes from nurturing it and watching it grow over the years. Remember, there's also a downside to holding stocks for many years. A stock that's doing fine today might be overtaken by its competitors, which can result in a drop in share price and dividends. Another vital concept to grasp is how dividend investing can help you navigate market fluctuations and bear markets. When the market is volatile, stock prices can fluctuate wildly, but dividends tend to be more stable. So, if you're a beginner, I highly recommend looking into the Dividend Aristocrats or Dividend Kings category of stocks. These are the stocks that have paid and consistently increased their dividends for over 25 and 50 years respectively. This approach will save you the hassle of sifting through a massive number of stocks, which in some cases can be over 2,000. Now, when you start with Dividend Aristocrats or Kings, you'll still have around 80 stocks to choose from. To keep it simple, you need to keep an eye on the following 4 metrics to make an informed decision. These are dividend payout ratio, dividend coverage ratio, free cash flow to equity, net debt to EBITDA ratio. Here's why these metrics are important. The dividend payout ratio tells us how much of a company's profits are used to pay dividends. If it's less than 50%, that's usually a sign of stability, and the company may have the potential to increase its earnings over time. Anything over 70% is considered risky territory because it leaves too little for the company to reinvest and grow over time. Next is the dividend coverage ratio, which measures how many times a company can pay dividends using its profits. A higher number is better because it means the company can easily cover its current and future dividend payments. Then there's free cash flow to equity, which in simple words is the money left for shareholders after all the bills are paid. It's essential that a company can fully cover its dividend payments with this money. And the last one, net debt to EBITDA ratio, checks if a company has too much debt compared to its earnings. It's better if this ratio is lower than similar companies. If it keeps going up, it might be a sign that the company could have trouble paying dividends in the future. So these metrics help us make informed decisions about which dividend stocks to invest in. And lastly, there's the dividend yield itself. Don't get tempted by a stock with a very high dividend yield. Personally, I set a limit of not going beyond a 10% current dividend yield for long-term investments. This is because in the long run, the current dividend yield doesn't matter much. It depends a lot on the dividend growth rate dividends. I'll explain that when we go into the details of finalizing the stock selection process. To avoid falling into a dividend trap, you should look beyond just the high yield. For example, if a company's stock price recently dropped a lot, its dividend yield might look very high, but it's not necessarily a good investment. The drop in stock price could be a warning sign that the company's facing problems, and there's a risk they might reduce their dividend payments in the future. The next step is choosing and finalizing the dividend stocks for your portfolio. There are multiple ways to do this. For short-term investors, if you open the Moomoo app and go to Markets, then US, then scroll down to Featured List, High Dividend, you'll see that Moomoo has this feature that allows you to filter through different criteria to find the most suitable high dividend stock for your investment. By tapping the top right filter button, we enter the filtering criteria page. We can, for example, specify the dividend yield and market cap so that we get a list of more stable and established companies. Here, I'm going to enter a dividend yield between 5 and 10%, and then a market cap between 10 billion and 3 trillion. There we go. I already see some familiar names. I can then tap into the individual stocks and go to their company, then Financials tab to conduct more due diligence on their financials. Check if metrics such as EPS, revenue, balance sheet, asset and liability, and cash flow are stable or within a reasonable range of growth. Now, as I said earlier, what I like to do is long-term investing. For this, I use the app to study Dividend Kings and Dividend Aristocrat stocks. Some of my favorite stocks for long-term investment are Abbott Laboratories, AbbVie, Target Corporation, NextEra Energy Incorporated, and Atmos Energy Corporation. To simplify things, I often look at what the big gainers like Vanguard, BlackRock, and JP Morgan are investing in. You can easily do this using the Moomoo app. In the top right corner, you'll find a search button. Type in ABT, which is the ticker symbol for Abbott Laboratories in our case. Once you've clicked that, you'll access the company profile. In this section, you can click on the company and see how the company and its stock are performing. You can also view their year-over-year revenue and EPS targets and whether they've beaten them or not. Most importantly, you can also see the analyst rating of a stock, which in ABT's case is a strong buy. Scroll down a little, and you'll see the reasons why. The company valuation gives you an idea of the why. You can see that ABT has a price-to-earnings ratio of 38.02. This ratio indicates the company's valuation compared to its earnings. However, you can also see how other stocks in the same industry are valued in this sector, which, in our stock's case, is 41.33. This suggests that ABT is undervalued and a good stock to buy right now. This approach is mostly used for short-term investing, but it can also help beginners choose a good entry point for their long-term investments. If you scroll down to the shareholders section, you can see that Vanguard Group and BlackRock each hold around 8.5% of this stock, which is a positive sign for long-term investors. There's another crucial aspect to consider when investing in long-term dividend stocks, and that's the company's history of paying and increasing dividends. You can conveniently check this in the app as well. On the same page of the company, all you have to do is scroll down to the end, and you'll find Corporate Actions. Click on Dividends, and you can see the entire history of Abbott Laboratories' dividend payments. You'll notice that they've been consistently increasing their dividend for the last 10 consecutive years. Additionally, you can calculate the average dividend growth for ABT stock using this formula. We can see that last year they paid $2.04 in dividends, while 10 years ago they paid 56 cents in dividends. Plugging these values into the formula, we calculate an average dividend growth rate of 13.8%. Using the same formula, we can calculate the average stock price appreciation. The current value of the stock is $112.74, and 10 years ago it was trading at $39.40. Plugging these values into the formula, we get an average annual appreciation rate of 11.09% for ABT. So now that we have all the values we need, we can calculate the future projection of the stock. We have a current dividend yield of 1.95%, dividend growth rate of 13.8%, average annual growth rate of 11.09%. Putting all these values into our dividend forecaster, we can see that if you invested $10,000 in this stock and reinvest your dividends, it will be valued at $11,304 by the end of the year. In 10 years, your investment will triple to $34,845. After 20 years, it'll be valued at $128,857. From here, you'll really be able to see the compounding effect. Check this out. Thanks to the dividend growth and appreciation metrics of this Dividend Aristocrat stock, after 30 years, this stock has the potential to grow your $10,000 investment and reinvested dividends to $514,772, paying an annual dividend of $18,902 or $1,575 per month. In this entire timeline, ABT has the potential to add $504,772 to my investment, with capital appreciation accounting for $380,759 and dividend reinvestment contributing $124,013. Same is the case with our other stocks: AbbVie, Target Corporation, NextEra Energy Incorporated, and Atmos Energy Corporation. To give you guys some context, here's what you can expect from the other stocks that I had previously selected. I've already calculated the dividend growth and average annual share price appreciation for the other stocks to save you some time. It looks something like this. Now, if you put these metrics into the dividend calculator, you'll get these values. From this table, you can see that every stock has performed exceptionally well in terms of future projections. However, the top performer for my portfolio will be AbbVie, which has the potential to add $1,232,145 and pay an annual dividend of $52,359, equivalent to $4,363 per month. This brings us to the next very important step. Anyone who looks at this table might be tempted to invest all their money in AbbVie, given its excellent future projection. However, that's where beginners often make one of their biggest mistakes: not diversifying their investments. No matter how discerning you are in selecting stocks for long-term investment, one thing is certain: there's no guarantee that these stocks will perform as projected. Markets, sectors, and stocks can be unpredictable. For example, if you invest only in technology stocks and the tech sector faces a downturn, your entire portfolio could be negatively impacted. By spreading your investments across different sectors, you can buffer against such sector-specific risks. So the next best solution is to create a portfolio of your best selected stocks. A good starting point is to begin with 5 to 6 stocks and consider expanding to 12 to 15 stocks for your portfolio. Remember, you don't want to over-diversify your portfolio to 30 or 50 stocks, because then you won't be able to keep track of your investments if they're divided among 50 or 100 stocks. So keep it simple and manageable at the start. So if I were to create a portfolio of my selected 5 stocks, it would have an average dividend yield of 2.91%, a dividend growth rate of 11.47%, and an annual value appreciation of 10.92%. Based on these metrics, if I invest $10,000 in this portfolio, after 1 year, my portfolio will be valued at $11,384. The same portfolio after 10 years will triple to $36,780. Fast forward another 10 years, and in 20 years, it'll be valued at $137,275. Finally, after 30 years, it will balloon to $520,351, paying an annual dividend of $15,524, or roughly $1,294 per month. While we didn't quite reach the $1 million mark with this portfolio, we've significantly increased our chances of reaching a valuation of $500,000. But there's also a way to increase your chances and get closer to that $1 million valuation. For this, all you have to do is add $100 to your portfolio every month. And after 30 years, your portfolio will have a valuation of $959,537, paying an annual dividend of $28,591 or $2,383 per month. Now that you know the best configuration for your portfolio, all you have to do is replicate that portfolio in the trading app. In Moomoo, it's simple, but for this you have to switch to the desktop app because as of now, there's no option in the mobile app. However, you can create a portfolio in the desktop app. Recently had a talk with them, and they're rolling out this feature to the phone very soon, so keep an eye on that. Here's how you can easily create a portfolio using Moomoo. After you've deposited your initial investment, click on Portfolio on the left section of the app. It'll take you to the Create a Portfolio page, where you can track all your portfolios. To make a new portfolio, click Create and add a portfolio name. For example, JMA Dividend Stocks. After you've created the portfolio, you can directly select your stocks and add them to the portfolio. Then you can choose how much of your investment each stock should hold. Since I'm assuming I'm investing equally across all the stocks, I'll allocate 20% to each stock. Up until now, we've focused on dividend stocks, but the same principles can be applied to exchange-traded funds. And for those interested in short-term trading, potentially, you can test your strategies in the futures market or the cryptocurrency marketplace. Now that you know the ins and outs of dividends, here are the top 5 dividend aristocrats to buy and hold forever. Paul Samuelson. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. This quote perfectly captures the importance of the buy and hold forever strategy, and it works when you invest in stable stocks like the dividend aristocrats, companies known for consistently increasing their dividends for over 20 years. In this video, I'll show you and John the absolute best top 5 dividend aristocrats to buy and hold forever, which promise not just steady income but also the potential for long-term growth. I'll show you stocks that have the potential to make you a multimillionaire and pay over $5,000 in monthly dividends. And in the end, I'll show you with a portfolio how you can achieve the same number with a considerably less risky strategy. But first, what makes dividend aristocrats special? Dividend aristocrats are special because they're companies that are really good at giving money back to their investors. These companies have a special status because they've been giving increasing dividends to their investors every year for a long time, usually at least 25 years in a row. What makes them stand out is that they stay strong even when things in the economy are not going so well. This is important because it means they're not likely to suddenly drop in value. To figure out if dividend aristocrats are good for you, follow these steps. First, find out about the company. What does it do, and how does it make money? Make sure it matches your goals. Look at how much money they've given to investors in the past. Coming up next, the top 5 dividend aristocrats ranked from great to the highest potential for growth and yield in John's investment. Starting at number 5, we have Target Corporation. Known by the ticker symbol TGT, this aristocrat has a current dividend yield of 3.02%, a strong track record of dividend growth with an average growth rate of 10.68%, plus an average annual growth rate of 9.95%, further solidifying its position as a dividend-focused stock. Let's say John invests $10,000 in this stock. After a year, his investment is projected to be valued at $11,297. In 10 years, it's projected to triple to $34,160. Moving on to 20 years, it's projected to reach $119,144. And at the 30-year mark, John's initial investment of $10,000 is projected to reach $424,932, paying an annual dividend of $13,940 or $1,162 monthly. In total, this stock grows his portfolio by $414,932, which includes $305,727 from the rise in stock value and $109,205 from dividends. Target's recent stock performance has been stable due to a modest sales dip, but signs of improvement are showing. The company has effectively managed its stock and met sales expectations. Additionally, its financial outlook has improved compared to the previous year, thanks to effective cost-saving measures positioning them for growth as sales recover. TGT's persistent appeal as an investment is reinforced by its remarkable 53-year streak of increasing dividends, offering reliability for income-seeking investors. Furthermore, the current lower valuation of TGT stock presents an attractive entry point for investors with anticipated future growth potential. It's a timely opportunity for investors to consider Target as a reliable choice for steady income and the possibility of future stock price increases. Next, we have NextEra Energy with the ticker symbol of NEE. This stock has a very attractive dividend record with a massive commitment to rewarding investors well through growing payouts every year. That's perhaps not all that shocking given that it's a utility, a type of company known for paying reliable dividends. With a dividend yield of 3.22%, an average yearly return of 9.89%, and a 10-year growth in dividends of 10.98%, this stock proves why it's earned a spot on our list. So, if John invests $10,000 in this stock, here's what he can expect. After 1 year, his investment will slowly grow to $11,311. Projecting ahead a decade, the anticipated value will grow to $34,773. If he stays invested for 20 years, the value of his investment will climb to $125,118, bringing an annual dividend payout of $4,348. After 30 years, his investment, thanks to strong capital appreciation and dividend growth, will climb to $467,579, paying an annual dividend of $18,039, which is a monthly payout of $1,503. In total, the value of his investment will grow by $457,579, with capital appreciation of $323,149 and an additional $134,429 from dividends. The company's regulated utility, Florida Power and Light, is the largest rate-regulated utility in Florida. The utility distributes power to nearly 6 million customer accounts in Florida and owns 32 gigawatts of generation. Florida Power contributes roughly 70% of the company's consolidated operating earnings. The company's high-quality regulated utility in Florida and fast-growing renewable energy business give investors the best of both worlds, a secure dividend and industry-leading renewable energy growth potential. To top it off, the stock has maintained a consistent dividend payout record since 1986 and has increased its dividend each year since 1995, earning it the status of a dividend aristocrat. Next up, at number 3, we have J.P. Morgan Chase & Company with the ticker symbol JPM. JPM's dividend yield is currently 2.4%, but for long-term investors, the company promises a very generous 10-year dividend growth rate of 11.1%. It also has a solid share price appreciation of 11.93% on average every year over the past 10 years. Based on these metrics, if John invests $10,000 in this stock, after 1 year his investment will be valued at $11,433. In 10 years, it's projected to reach $37,844. Moving on to 20 years, it's expected to grow to $140,737. And at the 30-year mark, John's initial investment of $10,000 is projected to reach $515,090, paying an annual dividend of $8,359 or $697 monthly. In total, this stock grows his portfolio by $505,090, which includes $433,742 from the rise in stock value and $71,348 from dividends. If you think these figures are good, just wait until the last stock, which has the potential to add over $2 million to John's investment. Also, in the end, we'll show you a portfolio that can considerably reduce the stock investment risk. Companies like JP Morgan only add icing on top of the cake, as it's among the largest and most well-established banks in the world, with a history of over 200 years. The company operates in various segments, providing a wide range of financial products and services to individuals, businesses, and institutions. JP Morgan is renowned for its strong balance sheet, meaning it holds substantial liquidity to prepare for economic downturns or uncertain times. This conservative approach to managing its finances has helped the bank navigate through challenging periods, such as the financial crisis of the late 2000s, and maintain stability. Despite the inevitable cyclical nature of the banking industry, JP Morgan has consistently shown resilience and remained a powerful player in the U.S. financial system. Its strong financial position and profitability give investors confidence in its long-term prospects. At number 2, we have AbbVie Incorporated with the ticker symbol ABBV. AbbVie is a leading pharmaceutical company known for its generous dividend policy. It has an impressive track record of increasing its dividends for quite some time now. Currently, AbbVie offers one of the highest dividend yields in the industry, standing at a very impressive 3.68%. But for long-term investors, the company promises an even better 10-year dividend growth rate of 14.11% and capital appreciation of 13.18%. If John invests $10,000 in AbbVie, after a year, the investment will be valued at $11,686. In 10 years, it's projected to reach $48,142. Moving on to 20 years, it's expected to grow significantly to $239,241. And at the 30-year mark, John's initial investment of $10,000 is projected to reach an impressive $1,230,917, paying an annual dividend of $50,212 or $4,184 monthly. In total, this stock grows his portfolio by $1,220,917, which includes $905,955 from the rise in stock value and $314,963 from dividends. That number might seem unrealistic, but that's how reinvestment strategies work. Reinvesting dividends multiplies your investment, and a decent dividend growth rate does the rest. AbbVie stands out in the pharmaceutical industry due to its strong dividend history and high dividend yield. The question is, why has AbbVie performed so well in the market? Well, their pharmaceutical product Humira has been a huge hit. However, its exclusive special rights have expired. And some are worried about how this might affect the company moving forward. But know this, AbbVie has a history of doing well even when things change. They have a long-standing reputation for increasing their dividends every year. Over the last 10 years, they've raised their payouts by a massive 270%, which is pretty impressive. What's even better is that they have a good amount of money coming in. They made around $24.8 billion in the past year. This shows they're in a strong position to keep sharing profits with investors even if their earnings slightly decrease. Now remember, at the end of the video, I'll share a strategy for risk reduction by blending companies like AbbVie with our top stock. Building a portfolio leverages each stock's growth strengths, effectively lowering overall risk while optimizing potential returns. But before showing the portfolio that will improve John's investment security, at number 1, we have Home Depot. Known by the ticker symbol HD, this company offers a current dividend yield of only 2.34%, but the reason it's made it to the top of the list is because of its extraordinary 10-year dividend growth rate of 18.28%. And if that's not enough, it also has a solid average annual share price appreciation of 16.67%. Before revealing how much value this stock can add to John's investment, let's see what makes this company so special. Home Depot is a retail chain with stores and an online platform selling home improvement items like tools, appliances, and gardening supplies. They serve DIY customers and professional contractors, providing a wide selection of products for construction and maintenance. But the thing that makes it an ideal company for a dividend portfolio is that it operates in the home improvement industry, which tends to be relatively stable and resilient even during economic downturns. This stability provides a consistent revenue stream, allowing the company to generate steady earnings to consistently pay its dividends. Okay, back to our investment plan. If John invests $10,000 in this stock after 1 year, the investment will be valued at $11,901. In 10 years, it's projected to almost six-fold to $57,848. Moving on to 20 years, it's expected to reach $347,079. And at the 30-year mark, John's initial investment of $10,000 is projected to soar to an impressive $2,173,178, paying an annual dividend of $67,125 or $5,594 monthly. In total, this stock grows his portfolio by $2,163,178, including $1,792,268 from the rise in stock value and $370,910 from dividends. This growth and return really is possible with Home Depot because of the company's dominant position in the home improvement retail market, giving it a competitive advantage. Its widespread presence, strong brand recognition, and extensive product offerings attract a large customer base, contributing to its revenue stability and strengthening its position as a reliable dividend stock. So, investing in these stocks is a great opportunity, but like any investment, stocks have risks, and you simply cannot put all your eggs in one basket. To minimize these risks, diversifying your investment is crucial. That's where the portfolio comes in. If you choose the stocks mentioned above and invest an equal amount in each, you can calculate some key metrics to assess your portfolio's performance. All you have to do is add the respective yield percentages and divide by 5. This will give you your portfolio's average dividend yield, dividend growth, and annual growth. For this portfolio of 5 dividend aristocrats, we get an average current dividend yield of 2.93%, a strong dividend growth of 13.02%, and an average annual growth of 12.32%. Let's say John invests $10,000 in this portfolio of 5 stocks. After a year, this investment will be valued at $11,526. In 10 years, it's projected to nearly quadruple to $41,700. Moving on to 20 years, this stock is projected to reach $177,174. And at the 30-year mark, John's initial investment of $10,000 is projected to reach an impressive $767,977, paying an annual dividend of $23,728 or approximately $1,977 monthly. In total, this portfolio significantly grows his investment by $757,977, which includes $592,617 from the rise in stock value and $165,360 from dividends. Impressive. So those were earnings from Dividend Aristocrat. That wraps up our half-year dividend journey. We hope this compilation has equipped you with the knowledge and confidence to turn your investments into a reliable income stream. Remember, your financial freedom is within reach. Keep investing, keep learning, and let your dividends do the rest. Thanks for watching, and see you in the next video.